Net present value. Now that we have gone over the conceptual basis of corporate finance, we are going to look at the main techniques and tools used in financial analysis and decision making. In business, we invest in projects that make money in the future. We pay now and intend to reap the rewards in the future. Usually, a project or asset will make money as a stream of revenues and profits over years. It could also be a project whose main benefit is savings. We need the ability to calculate whether that stream of future cash flows is worth more than the money we need to invest to buy it or to build it. The way we look at decisions about whether to fund a project or calculate the value of an asset is to turn that stream of future dollars into today's dollars. Then we compare that sum of present values to the cost. If the cost is more than the total present value, we don't do the deal. If it's less, it's considered a good deal. This is the way projects are analyzed and assessed as go or no-go, and how income-producing assets and acquisitions are valued for sale or purchase. So far, we have analyzed and calculated the value of future cash flows and brought them back to the present value. Now, net present value, NPV, takes this idea a step further and accounts for the transactional aspect. We must purchase the future cash flows by either buying a bond or stock, acquiring a company, purchasing an income-producing asset, or undertaking a project and incurring the costs of developing or building that income-producing asset. Net present value nets out the cost of acquiring the future cash flows. NPV compares the cost in today's dollars to the present value of the projected income or benefits also in today's dollars. It's only worth doing if the price is less than our assessment of the future benefits. NPV is the main tool used to value assets and make decisions about projects, purchases, mergers, or acquisitions. The spreadsheets can get pretty complicated when they are populated with all the costs, revenues, and expense projections, and the assumptions about the timing and the risk. But the basic idea is always to compare the costs to the future benefits and compare them apples to apples by taking into account the time value of money. NPV answers a simple question. Does the present value of all the money coming in over the life of the project outweigh how much money we have to spend in order to receive it? Net present value is just that. It's the net between the present value of these two streams, the money going in and the money coming out. We ask whether NPV is greater than zero. If it's greater than zero, then the costs are less than the benefits, and we should do the project or make the investment. That's our decision rule. Is the NPV bigger than zero? We can construct a formula for NPV by following along very closely with what we did in our discounting cash flows. The NPV is equal to the initial cost, which has a minus sign in front of it, plus the present value of what's coming in off the project as cash flows. Cash flow in period 1, discounted back 1 period, plus the cash flow in period 2, discounted back 2 periods. The cash flow in period 3, discounted back 3 periods. You get the idea. Plus all the other cash flows coming in by their period. What we do is take that initial cost and weigh that against the present value of all the cash coming in. We're going to net the two. There's a minus sign on the costs and plus signs on all the present value cash flows coming in. We ask how all the money going out weighs against all the money coming in. Think of it like a balance. If we know the initial investment and the stream of money coming in from the project in the future, we can measure the NPV as the difference between the two, the net between these two streams. As the initial investment becomes larger, the NPV becomes smaller. You can see that the NPV, whether it's bigger than zero or less than zero, depends on the balance between the money going out and the money coming in. Let's work a problem and compute an NPV in practice.